Let's talk about our million-dollar portfolios. For some of us, like myself, that's a little further out, and for some of you watching, you've already gotten to the seven-figure club, or are rapidly approaching it. Either way, we'll all eventually be in a position where we want to protect and maintain as much of that value as possible, and we'll want to extract income from our investments for retirement, financial freedom, all that super important stuff. The thing is that this can be done in a number of different ways, and with inflation, rising cost of living, and the general uncertainty of life, some strategies will work better for some investors, and one very popular strategy is likely not going to work for us younger investors, and may not work for older investors as well. So in this video, I'm going to show you the ETFs that can help maintain a $1 million portfolio because they generally keep up with the overall markets, can outperform them in the right conditions, give us a decent yield in the process, or some combination of all three. Remember, this is a personal list, so if you disagree, feel free to let me know your favorites in the comment section down below. Remember, I'm not a financial advisor and this isn't financial advice. The best way to use the information in this video is to use it as a starting point for conversations with a professional because we all have different financial situations and future goals. With that being said, let's get into it. The first ETF I want to talk to you about is VOO. This is the Vanguard S&P 500 ETF, and its goal is to track as closely as possible the S&P 500 index, which is widely considered to be the overall market. Buying this ETF means you never have to worry about underperforming the market since you're effectively buying the benchmark. With a 1.48% dividend yield and an extremely low 0.03% expense ratio, you get to enjoy watching your money perform exactly as expected without lifting a finger. If the S&P 500 is having a down year, just about everyone is having a down year. And if it's up-only season, the S&P 500 will likely take part in the ride up. Some investors would benefit from the peace of mind, and historically, over the long term, the S&P 500 has an excellent track record. And remember that a large majority of market participants do not beat the overall markets year over year. VOO just seems like the easiest way to win when it comes to investing, especially in the long term. However, I recognize that a 1.48% dividend yield isn't exactly the highest dividend we've ever seen, and if you're looking for something that can keep up with the market but offers a higher yield, that brings us to our second ETF, SCHD. SCHD is my largest individual holding in my income/dividend portfolio, and it's very popular among dividend investors for a reason. Well, actually several. The Schwab US Dividend Equity ETF has kept up with the S&P 500's growth since inception reasonably well, even outperforming it at one point in time in November of 2022. It has a dividend yield of 3.6%, an extremely low expense ratio of just 0.06%, and just paid out its largest dividend on record in December of 2023 at 74 cents per share. So with just one investment, you get to keep up with the overall market. You get a sizable dividend yield and a growing dividend, all for an extremely low cost to own. No surprise why it gets a lot of attention. The thing with SCHD is that if you compare it to VOO overall, yes, it has kept up with the markets from an overall returns perspective, but we do want to take into consideration that even without dividends reinvested for both VOO and SCHD, SCHD kept up, which means that the position isn't relying on its dividend to maintain its value. So investors don't necessarily have to sell shares should they want to extract value from the portfolio based on historical performance. Of course, future performance is not guaranteed. Now I know what you're thinking, Raj, 3%? We can do better than that. Well, our third ETF is JEPI, also known as the JP Morgan Equity Premium Income ETF. This is a covered call ETF and it sells options contracts, which then generate a yield, which is passed to investors. So because of this, it can generate massive dividends, and JEPI currently can justify its expense ratio of 0.35%, given it has a dividend yield of 9%. So covered call ETFs come in many different forms. JEPI has been around for a while, and the data shows that overall it kept up pretty well with the markets, and it's maintained its principal pretty well since inception without dividends reinvested. So investors are overall positive even if they decided to take the dividends out of the position and not reinvest them. One of the main benefits of having a covered call ETF in a portfolio is the potential to earn a high yield through a sideways market. Naturally, in a bull run, everything generally speaking is going up in value, and during a bear market, things tend to do worse. Keep in mind, covered call strategies are naturally limited in their upside and capture all of the downside. upside. The trade-off is the income potential. All things considered, that's all pretty normal. What we don't often talk about is when the markets sort of just range for an extended period of time, and covered call ETFs like JEPI can provide some upside when the markets aren't too busy setting new all-time highs. But fair warning, these will likely underperform when a bear market swings around again. So for a younger investor like myself, it's a great time to dollar cost average in, but for older investors, likely this is not your best move. And our last ETF may be a bit controversial, but hear me out. It's QQQ, which tracks the NASDAQ 100. Since inception, QQQ has had an impressive run, significantly outperforming the S&P 500, with a barely noticeable 0.56% dividend yield and a 0.2% expense ratio. That's not really why any investor goes for QQQ. It's become very obvious that big tech and other non-financial companies, which is what QQQ consists of, have become incredibly valuable and will likely only be more valuable as we get more dependent on these companies and their breakthroughs. So yes, the volatility of this ETF can be a concern for maintaining $1 million portfolio, but if history is any indicator, the ups far outweigh the downs, and if you've had the discipline to get to $1 million portfolio, you can likely hold for the long term and allow for those bull markets to generate outsized returns, which can help keep your portfolio growing. Some investors might agree with the statement, the best defense is offense, and I would argue that QQQ is a top performer when it comes to overall returns. So we had an ETF that focuses on the overall market, a dividend ETF, a covered call income ETF, and an ETF with historically high growth with more volatility in the mix. That's a lot of different ETFs that will get different results and may or may not work best for certain retirement strategies. But one final point I want to make is the concerns I have for the 4% rule, which some of you out there are planning on using and might not be an option for us younger investors, at least not in its original form. The concept is relatively simple and the promise is extremely desirable, which is probably why it's so well known. You take your investments, you sell 4% the first year of your retirement, you live off that for the year, and then the following year you sell 4% again, adjusted for inflation. In theory, you shouldn't run out of money for 30 years, which would likely be the rest of your life. Now, all that sounds great, but the 4% rule was based off a portfolio that consists of 60% stocks and 40% bonds, which may not be what your portfolio actually consists of. And bond rates were generally higher back in the 90s when this concept was introduced. As a child of the 90s myself, I can confidently say things are way different now. So maybe this 4% rule isn't the best option. In addition, expenses, specifically healthcare expenses, go up as we get older. So that is something to consider as well. Did we mention record inflation? So when you're using a rigid rule for a dynamic cost of living and constantly changing market conditions, that can be challenging. But then there's the other aspect of this. If you're like me, the idea of selling all my assets doesn't really appeal to me. How am I supposed to leave something behind for the next generation if I don't actually have anything left to leave? Look, if the 4% rule is working for you, I'm happy about that. I do believe it can work for some individuals, but I also believe that it doesn't work for others and likely won't work for me given what I've seen happen in the markets and economy over the past few years. And of course, this takes into consideration my own personal preferences. So as things change, our strategies have to change as well. For me personally, I like the major ETFs like VOO and QQQ since they can grow over time and I can sell shares as needed. And I like dividend-paying ETFs like SCHD as they can keep up with the markets and will likely give whoever I leave these shares to a good leg up. And I also like covered call income ETFs like JEPI for the higher income potential that is lacking in the other ETFs mentioned, and I'm okay with the risk-reward trade-off. There's a lot of great ETFs that can help investors get the most out of their money for whatever retirement strategy they choose, whether that's the 4% rule, living off dividends, some combination of both, or maybe even using an investment portfolio to supplement income in the later decades of life and never really truly retiring in the traditional sense, which may also work for some people as well. Hopefully this video was valuable for you and got you thinking about different strategies for maintaining and living off your investments. If you're really considering switching up your strategy, be sure to consult a financial advisor before doing so to avoid any major setbacks. And if you enjoyed the video and found the information valuable, let me know by clicking the like button. Let me know your thoughts in the comment section down below, and be sure to subscribe for more content. Thanks for watching, and of course, good luck in the markets.